Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be calling out STEM Inc. This is a fan favorite on the channel, and one of the reasons why I want to talk about STEM in particular is they had a monster day on Friday. So they were up $1.28 on the day. They were actually higher than that at some points during the day, and you can see the previous close was about $6.50, so this was a super strong day. But I want to highlight some of the latest news that is showcasing associated with the stock. So on May 6th, or rather on May 5th, they announced earnings. On May 6th, you can see that the stock had a strong day, but then it kind of declined due to the fact that the overall market was struggling. And since that point in time, you can see that it's been overall market. So the fact of the matter is the company as well as the broader market is trading in a very volatile manner, largely due to the fact that we see a lot of macroeconomic impacts that are occurring that are hurting the stock, that are hurting the overall market, including a tightening monetary environment as well as interest rates continuing to climb. And then we also have a lot of companies that were expecting to do much better this calendar year are announcing weaker earnings. So at this point in time, STEM actually announced pretty strong earnings from a overall perspective. You can see that they basically came in line with expectations, a little bit of a beat, but overall the more important thing is how they performed in terms of revenue. So what I would highlight here is we've got it on the quarterly view. I'm using TD Ameritrade to showcase this information. And what we have right here is their total revenue was 41 million, almost 41.1 million, which was their second best quarter ever. Now, year over year, that was up over the prior quarter, which was 15.5 million. So the company is growing incredibly quickly, and that points to a lot of really healthy components of the broader market in terms of energy storage and the software that's used to deliver an efficient approach. But I also want to highlight why I'm not encouraging people to chase the overall stock right now. So you can see over the past 2 years, the stock, when it was still in SPAC form, went up north of $50 a share at one point in time. And if you look at this, it's been on a steady decline ever since that point in time. Over the past year, similar story. So while I'm by no means a financial advisor and everything I'm highlighting is just my opinion, I want to highlight that the blip that we saw this past week is the extent of that incline that you see right here. So the stock is still well below kind of the year-to-date average, which I would say is between the 1250 mark, potentially the 10 to 1250 mark. And so what I'm hesitant to do is encourage anyone to go chasing after this stock, because at some points in time it was up as much as 21.5% this past week. All in all, there is a few key components that have me concerned over the current market valuation. The first thing that's going to be highlighted here is at the end of the day, the company is still not profitable. The reason that I highlight that, again, STEM I've known is not going to be profitable. They're not expecting to be profitable till 2023, and even that could potentially be doubtful. But the market wants to know that companies are not going to be raising capital at this point in time. They want to know that they're going to be able to stand on their own 2 feet. And they also want to know that it's going to continue to be more profitable in the future. So as such, you can see that the company, having their third best revenue ever, also had their second highest expense ever. Now, what I want to highlight is we are not counting the warrants in some of that weird expenses that we've seen previously. So what we're highlighting or pointing to right now is the fact that the company is still losing quite a bit of money. Again, takes money to make money, but we want to make sure that this number is continuing to decrease. Now, they have increased their labor expenses quite significantly. They've hired a lot of sales reps. They continue to scale. We also see that they are doing a lot of incentives to go out and get larger deals. Those are going to be more hardware related to set up for a longer period of time for the software. So when that's happening, again, this is all part of the plan, but these are concerns from a broader market perspective. Because until they are profitable, the company is always going to expect that they're going to need additional capital. And where is that capital sitting right now? Well, currently the company has about $175 million in direct cash. One of the reasons why we see such a large drop between that 748 and that 175 is due to the fact that they acquired Also Energy, which was directly accretive to their overall revenue. So this was an investment that they made. However, you can see that they have 175 million in direct cash, another 177 million in short-term investments that are hopefully going to be relatively liquid. So what this means that at the current cash burn rate, and I'm expecting that it will most likely go up, but you can see that that cost of revenue, should we expect this to continue to increase? Should we expect the company to continue to see a large increase in their expenses? Again, you can see operating expenses from the quarter before as well. Then they're going to continue to wear down that overall cost, or rather that overall cash pile. So if you're looking at this, they've got basically 2 years left before they're blowing through all of that cash, which would lead us to believe that they would have to do another capital raise via share issuance or potentially take on more debt. And right now their debt is very, very attractive because they're only paying 0.5 percentage point to take on all that cash. So these are some of the areas that I think are negative associated with the company. The other thing I would highlight would be the supply chain. Right now, they continue to reiterate that they're not going to have any issues with supply chains. However, I always want to highlight that a company, if they have really bad news, they're not going to be incentivized to tell you. So they have their supply chain secure right now, but Q4 is their big quarter. So that is to say, I'm going to wait and see. Still a believer in the stock, still like what they're doing, but I want to make sure we're taking into account both sides. What I'm looking at here is some of the potential. So the price to earnings ratio right here, the industry is currently trading at about 30x price to earnings, or PE. Now, keep in mind that as far as the quote-unquote industry goes, associated with STEM, I don't have clear visibility into what TD Ameritrade is leveraging for their industry aside from electrical equipment industry. And we don't know if I would, or I personally don't know if I would put STEM in that electrical equipment. But because they're currently classified as that approach right now, I would highlight that the 30x PE ratio is very attractive because they expect to have more than $100 million in free cash flow in 2026. So right now, if we're looking at the industry price to sales, should STEM continue to grow their sales at the rate that they expect, and they actually execute on that performance, even going from a 6.3x price to sales to the industry average of 15.47x, would be incredibly attractive. Again, the stock is currently trading at 776. So one of the things that we need to look at is continued execution on sales. We want to make sure that they're continuing to grow. The second component is cutting those costs. You can see that net profit margin right now, this is on a trailing 12 months basis, so the past 4 quarters, it's currently sitting at a negative 27%. Now keep in mind that this is starting to climb higher, as well as we do have the warrant noise in these financial statements. So at the end of this year, I expect this to be quite a bit cleaner, but we want those gross profit margins to be closer to 20 to 30%, more in line with the industry average, especially as more of those software projects come online. The attractive thing that we're going to focus on right now is going to be the revenue growth. Now, what we need is the trailing 12 months, which they haven't had at least 4 quarters or 8 quarters of revenue growth to be able to support the trailing 12-month revenue growth. But quarter over quarter, we're not overly concerned on because they went from Q4, which is their historical high, to Q1, which is their historical low. But we are going to be watching to see if they can continue to outperform to grow at more than 100%. So at the end of the day, the company continues to perform very, very well. It's one that I'm going to continue to watch and one that I am going to continue to invest in because there is a lot to like and there's a lot of potential, but I still want to make sure we're taking into account the fact that the broader market is going to be dictating some of the short-term price movements before STEM is able to stand on their own 2 feet and under their own valuation. So if you have any feedback, please let me know in the comment section down below or in the free to join Discord that's linked in the description. Thanks. Hope you have a wonderful day.